All right, Brian Dalton, welcome to the Resource Insider podcast. Thank you very much for taking some time today.
Hey, thanks for having us on.
So, Brian, I have a list of questions here in front of me that I'm hoping we can get through today. There's a lot, and I've been looking forward to this interview. So I'm not sure we'll get to it all, but I want to be talking today about, of course, Altius Minerals, the royalty company you started, almost 2 decades ago now, and I want to be talking about Altius Renewables, one of your newer ventures, and an interesting, I might say, trajectory change, but maybe that's not the case. But before we start, before we get into anything, can you give us sort of the 30,000 foot view of what Altius is, what you guys do, and your background, and then we'll dig into that in some more detail.
Sure. Small correction to begin with. I'll be CEO of Altius Minerals 25 years next year.
25. Wow. Okay.
It's flown by. Um, Early start, obviously. I was in university when I was part of the co-founding group of Altius Minerals. It was a weird set of circumstances. Up to that point, I'd personally been prospecting and selling and optioning properties to companies, really just to fund my geology education. When the Voisey's Bay discovery happened in our home province of Newfoundland and Labrador, it resulted in probably one of the biggest area plays in Canadian history, and we were Johnny on the spot. So basically, sort of pooled together all my classmates as a bit of a staking army, and we took over half the computer lab at the university and started staking claims and optioning them on. So it was a real sort of sudden windfall-y kind of event, and that helped obviously because it put some starting capital in place to think about doing
Yeah.
something like taking a company public. But it was also a big learning experience just in terms of how markets work, and in times like that when it was just so hot and exciting, to be honest, a lot of the players that showed up looking for our properties that were running public junior companies were maybe less than impressive.
Yeah.
Some of them I don't even know if I trust to walk my dog in hindsight. But anyway, it was just the combination was, a few of us looked at each other and said, you know what, if they can do it, we can do it.
Yeah.
And
So
we did it.
were you guys out there sort of staking properties and acquiring ground sort of prior to the Voisey's Bay discovery, or was that kind of what ignited the imagination, or were you already at that? Because the reason I ask, I went to engineering school. We did classes with a lot of geologists, and we were at U of T in Toronto, and I didn't know any U of T geologists that were sort of staking ground and acquiring land when we were in school.
Yeah, no, it was basically, from, even before I started university, I was prospecting and, finding real things with
Mm-hmm.
goings and optioning them on to various juniors. So I'd done a few deals actually up to that point. And, that was part of why the Voisey's Bay Rush was lucrative, because I had already been to the Vancouver Roundup, for example, as a 19-year-old, and had met lots of junior companies. So when they were looking for someone in Newfoundland who might have claims to get them into Voisey's Bay Rush, we had a bit of a head start. And plus, put some deals together already by that point. So yeah, and it was already underway probably around 18 or so. I think I was 18 or 19 when I optioned my first project.
And is there a culture of prospecting in Newfoundland? Is this something people just do on a regular basis, or was this a family sort of tradition for you, or something, a niche that you'd somehow stumbled your way into?
Uh, Man, if you really want to get into the background, I was actually set to become a commercial fisherman. So by the time before I was even out of high school, I'd already started a bit of a fishing enterprise. But there was a wholesale ban on fishing for a period of time, a full moratorium that was called. So my first entrepreneurial venture kind of got yanked out from under me
Yeah,
pretty
yeah, yeah.
unceremoniously, and I knew I wanted to do something outdoorsy, and so I, migrated towards prospecting and geology. And but overall, yeah, there's a huge culture of prospecting in
Hmm.
Newfoundland. Most of the major discoveries and mines that have happened here over the last 40 or 50 years have their roots somewhere in a prospecting discovery.
Mm-hmm. So, okay, and then how did you make the transition rather from, staking ground, prospecting, et cetera, flipping properties to actually sort of starting Altius Minerals?
Mm. So that decision obviously came post the Voisey's Bay rush and knowledge and bit of capital that was put together in that period of time. We were still completing studies, so I was literally, writing my bachelor's honors thesis at night and listing the company by day. We came out, got on the, did a junior capital pool type listing. The original starting market cap was around 800,000 or so.
Mm-hmm.
IPO raised 300,000. It wasn't great timing well, maybe it was in hindsight, but I can remember being up in Calgary where we listed on the old Alberta Exchange at the time, and in the room with the brokers trying to work out the deal, or the corp finance guys, and there were brokers busting into the room, literally busting into the room with press releases printed off asking, do you think there's any gold here? And Bre-X was literally exploding around us as we were trying to do this. So,
okay.
Anyway, we got the IPO done, but we came out and hit the ground running with a pretty ugly market backdrop. So any idea we might have had for a more traditional model of here's our great project, give us some money, we'll drill holes, cross our fingers and we're all going to be rich, kind of went out the window because there was just no capital availability. And, we were put in a spot of thinking about, will this thing even get off the ground? Is it just going to end up, debt by dilution kind of overnight? And it forced us into thinking about, it was myself and Roland Butler were the primary founders. He was a fellow student at Memorial who was also, had a background he was option claims in high school. And it forced us to think about a business model that would work for us. And we literally just turned Altius into a glorified version of what we'd been doing previously as individuals. So it became, I guess it wouldn't even have been a term then, but we became a project generator. We felt that we could operate very effectively and at low cost, particularly on the island of Newfoundland at the time, which we knew so well. And rather than raising money to drill the holes, we would option these projects off and let bigger players that were better funded do the heavy lifting. And we would own a small piece of these project interests. But ultimately what it would do is allow us to preserve our own capital structure. And really that's where it was born of adversity. So yeah, that's how Altius started out its life as a project generator. And it turned out it was a pretty darn good one.
And you said that was sort of not a term that existed at the time. Were there other companies doing what you guys were doing?
There were a couple of groups that, so as we tried to articulate what we were doing, we were scouring to see who else might be doing this or something like it that we could learn from. One group that stood out was, at the time, the biggest project generator name would have been a company called Southwestern Gold.
Mm-hmm.
Very successful project generator in its day. It ended up morphing its business strategy after, and I don't think things ended all that well for it, but in its day, it was a powerhouse. And the other group that we've looked at a lot and fortunately got to know the principal of pretty quickly was the original Virginia, run by Andre Gaumond, and he was a really great mentor and source of advice. But we're also found early by individual investors such as John Tognetti, Rick Rule, and Alan Young, who I think were really good at helping us fine tune the model, and they had their own ideas about more intelligent ways to do exploration. And we were pretty moldable. We were kids, but overall, collectively, I'd say it was a lot of lending of knowledge from others and just a bit of emulation here and there, and then just a few twists along the way that we came up with ourselves.
And did it work well out of the gate? Did you put yourself in a position where you were able to explore what you wanted to explore, that you didn't have to dilute, that you were able to bring cash into the company effectively? Was it, was it kind of you turned the taps on and it started to work, or was there sort of hiccups in this?
Well, you still had that market backdrop out there, which was tough, and we still needed some capital to even to generate the projects to begin with that we could potentially, farm out. But when we started the company, we'd rolled in a number of projects that we held ourselves individually. So we had a starting base of projects right out of the gate. And so the first job was just to get busy and getting people in on and working those projects. And I think we kind of established ourselves pretty quickly in that regard. We signed up BHP Billiton, we signed up Tech, 4 or 5 juniors. I think we signed, within the first year of IPO, we'd signed up 5 or 6 joint ventures, or option agreement joint ventures. And, also again, then attracted the Cognettis and Rick Rules of the world. Mm-hmm. So we were able to raise enough money to keep the generative wheels turning. Those guys basically, those handful of people just kept writing us $100,000 check each year for a couple of years. But more than anything, the dollars being invested by partners as a function of the dollars we were spending really started to ramp up. And news flow. We had news flow because we had all these partners putting money to work. You got to remember, at that exact point in time, all of our peers in the junior mining sector were changing their businesses to become .coms of one sort or another.
Okay.
So, it was a ripe environment on one hand because lands were just becoming available, good projects. There was no competition on the ground anywhere. But yeah, it was, I can't say it was easy times, but we were kids. We were having a ball. We were doing deals. We were signing deals with majors. We were putting press releases out about drill holes. And, these legendary investors were writing checks to come into our business. The company was still tiny, but we felt like we were making good headway. And eventually the market turned. So you get into early 2000 sort of time frame, 2001 maybe. And .coms had all blown up. And money was starting to look at our sector again. Gold prices started to move. And lo and behold, we were noisy. We had news coming out. We were drilling nice holes, announcing a new joint venture with Barrick and new concept plays. So while everybody else was really trying to, rechange their businesses back to mining from their .com adventures and get projects, we had a flying start. We were already going pretty hard, and the market treated us well early on. So we went to $1 by 2001 from 20-cent IPO start, and not bad after 4 years of probably the worst bear market in history.
Yeah. And when I look at your history, it strikes me as one of the big transformational events for Altius was obviously the acquisition of the Voisey's Bay royalty in 2003. So, what gave you, the idea, the confidence, sort of the plan to go from prospect generator, staking ground, exploring, to actually going out and acquiring sort of, cash flowing assets from producing mines? Or was it cash flowing? Do I have that wrong?
So much. It wasn't. No, it was before it was in production.
Yeah.
But
Okay.
It was after sort of the politics had settled down, and it was, mine plans or the permits were approved, so it was on its way.
Mm-hmm.
I don't think construction had started or it was about to start, but it was through all of the will this happen or not happen kind of questioning, but it was still a couple of years away from any kind of revenue. But the idea was not actually at the time to, in all honesty, to invent a royalty generator or to become a royalty company.
Mm-hmm.
It was about what I'd mentioned earlier. We still needed money to generate projects. So there was option payments and those sorts of things coming on, but there was still a burn. And that dilution was creeping up as a result of that, a few 100,000 here and there, and there you go. Next thing you know, your share count's getting up there. And I don't know what it was, but we always felt like our capital structure was like our life, right? This was the pace that expanded at was going to be the driving force to how this worked or not. So we've always been fierce protectors of the capital structure, which made this somewhat counterintuitive because it was a big investment. The purchase price for the royalty was, similar to the market cap of the company at the time. And it was equity. The only source of capital we had was equity. So it was actually a big slug of dilution that we had to take on to buy that royalty. But here was the logic. It was that this was the last equity financing we'd have to do, because now we would have a very long-term, steady source of capital, cash flow coming in on which to fund our business. So we just felt like we could get off that treadmill a little bit. And so that was where the original idea was. But, as we went through the transaction and afterwards, every time we'd farmed out a project up to that point, we were selling them on, retaining royalties. And so it all kind of started to come together a lot, how the whole project generator model and the royalty model were, in some ways intrinsically linked.
Mm-hmm.
They weren't, they should be.
So, okay, so you raised the equity, you bought the royalty. A few years later, it was cash flowing. And so am I getting that time frame right?
A few years later, yeah, it was not only that, but like when we bought the Boise's royalty, I'm pretty sure we used something like I think the consensus nickel price at the time was long-term was 323. Mm-hmm. That was the basis for the purchase. I will tell you this was sort of early days internet stuff, but I can remember Googling what net asset value meant and having to learn that while we were figuring out what to pay for it, or at least when the brokers asked questions.
Yeah,
so
yeah.
That we
yeah. Okay.
Listen to it.
Yeah.
Anyway, we came out of the gate and nickel prices, I don't know what they were, it hit production, and all of a sudden nickel prices were 7, 8 and quickly on their way to 20. So we ended up with payback on the investment, like, I don't know what it was, in quarters, not years.
Yeah.
So that was probably a little emboldening as well as far as our royalty buying goes, but that's not what happened next. That's not like, okay, let's go buy a bunch more royalties.
Mm-hmm.
What happened next was the project generation business, the core business, really got traction. So, the forces that drove nickel from $3 to $20 and gold was now at whatever, were obviously really constructive for exploration overall. And we had a lot of projects that we've been able to assemble in that downturn. And we'd morphed our business model a little bit. We were less focused now on selling projects to majors in exchange for retaining minority interest in projects. And we shifted gears a little bit to trying to deal more with really high quality juniors, such that we would then sell the projects on in exchange for equity in their businesses. Mm-hmm. And a retained royalty. So we just changed our form of ownership. We kind of felt that even if we had a minority interest with a major in a big discovery, it was, what are we supposed to do with that? What are we going to do? Just go, raise our third of, $3 or $4 billion for a project development.
Yeah.
Anyway, it was a twist. So here it goes. So now we've got all these equity positions from the sale of projects, and the market's taking off, and all of these things just ran. A couple of them were actually based on projects that we'd sold on, retained equity in, and discoveries got made. So, there was just massive price appreciation. And before we knew it, by like 2010, 2011, we had profits from the sale of projects and then partial monetizations of equity positions of over 200 million. Now let's recap here. We started at the bottom of the cycle with a $800,000 market cap.
Yeah, it's quite a trajectory.
Pretty crazy stuff. Now that was a problem. It was a weird problem to have, first class, I suppose. So we're this business that's supposed to reward its shareholders by using our brains and ideas to find projects, development low cost, sell them on, and have discoveries and all that sort of thing happen. And it was obviously working. But here's the trouble. We had so much money in the bank that any one of those types of successes could hardly move the needle anymore, because it was sitting underneath that much cash. And so there were real pressures there. Like, what do you do with that much money running the business model that we're running? And of course, lots of people had ideas that, oh, well, it's easy. Now you start to become a mining company, right? Well, I can guarantee you that was never in consideration. Not our skill set. We thought about dividending all the cash out and sort of shrinking back the value of the business so that, what we'd been doing, thought we could continue to do would still make a difference. And, you know, it wasn't the time for that. The shareholders had a lot of pushback. Everybody who was a resource investor at that point was pretty flush. They didn't need special dividends and that sort of thing. And we got challenged pretty hard. In fact, some of the people we talked to about it, I kind of got angry even. It's like, what do you mean? Like, you know, challenge yourself, figure out something to do here.
Yeah.
You know, we've had a great ride and we want to keep this going. Anyway, the long and the short of it is that the decision we made was that we would use that cash to buy more advanced stage royalties and sort of fill out. We had lots of early stage royalties. We had Voisey's Bay, but we wanted to fill out the cash flowing or advanced stage part of the portfolio. And we said, we'll use that cash to do it. And we communicated that. That's what we'll do with the money. Finally, here's your answer. Here's what we're going to do with the money. We're going to grow out the royalty part of our portfolio. We made a list of what assets we wanted and the types of assets that we wanted. Generally, like, you know, stuff that you'd just be so proud to own, mines that we were really covetous of. I remember right from the get-go, the potash mines in Saskatchewan was like top of the list. Like, that's, you ask yourself, what do you want in a royalty? And what do you want in an underlying asset? And that just hit everything out of the park for us. We chose not to go into the precious metal side of the royalty business, even though that was, you know, becoming more in vogue by then.
Yeah.
Because of that, we didn't. We felt it was a very well served space. And fundamentally, when we thought about what was important to us in a royalty, in terms of the, you know, expected resource life, opportunities for expansion, quality of counterparty, just overall scale and quality of assets, we felt it was far more present in the base and bulk side of things than the precious metal side.
That's quite a contrarian view, right? Because there's something like 30 publicly listed royalty companies now. Most of them, you know, just have been created in the last few years. I mean, it's got to be at least 95% of them are precious metals focused, right? Maybe even a lot higher. In fact, yours and one others is the only one I can think of off the top of my head that doesn't primarily focus on precious metals. I mean, was that just a matter of sitting down and doing the math, or what brought you to that?
But we might be actually becoming in style right now. Every precious metals royalty company I hear from lately talks about how they're going to grow out their non-precious components. So might be like fashion trends. If you wait 20 years, it'll be in style again. But it was more fundamental. It was about, just put it this way: the average gold mine, you know, the capital intensity is pretty small. Like, you know, small companies can go ahead and build a gold mine, and you can do it on a relatively short life asset. But if you're a royalty holder of an average precious metal mine, say with 10 years life, you buy it here, you hope you get the gold price right. And at the end of 10 years, for the most part, the royalty is absolutely worth nothing, right? Because the mine has been depleted. And all along the way, you've probably dealt with a fairly dodgy counterparty who's undercapitalized, and, you know, that kind of capital, you can be in different kinds of jurisdictions. So it's not a statement about all gold mines, obviously, but just the sector in comparison. Whereas on the base and metals and bulks, tended to be much bigger capital type assets, much stronger counterparties almost by definition, just to get these things off the ground.
Right.
So you needed much bigger resource lives to support that kind of capital investment. And we thought about it from the perspective of the royalty model. So in contrast, that other example would say a potash mine. If we can get a royalty there, huge capital businesses, incredible resource lives, by definition, only strong players can get this stuff off the ground. So you have all those boxes ticked to begin with.
Yeah.
But here was the key. In 20 years' time with the potash royalties, we felt that you're buying them and this is the production rate. And the resource life that's implied at that production rate is, you know, 1,000 years or more. Well, in 20 years, I bet you if you go back and look at it, guess what? That production rate will have increased. They'll have expanded that operation as market demands have grown. So in 20 years, you go and revalue that asset, you've still got, let's say they've doubled the production rate and half the resource life that's an enormously accretive
Yeah.
event, and you've still got 500 or 600 years of life left. And so just fundamentally, intrinsically, we thought there was the royalty model actually worked better fundamentally for these big long life base metal type assets or bulk assets than they did for this gold space. The difference, of course, was that the equity cost of capital for being involved in the gold space was lower.
Yeah.
For whatever reason, not because the assets are better, but because it was gold. You could get a big premium in the market for gold based. I mean, a dollar is a dollar from a mine as far as we were concerned. And ours has actually got longer life, more annuity like characteristics, and stronger counterparty and asset profiles.
But it
It
hadn't
was hands down
previously.
to win from a fundamental point of view, but the counter cyclical part was we knew it was not likely going to give us that really really cheap equity cost of capital that the precious metals guys had.
So, one of the advantages, in addition to that, in precious metals, and I think you kind of touched on it earlier, is the fact that so many of your counterparties, so many of the operators are, perpetually undercapitalized, and they actually often need to sell a royalty in order to put the mine in production or expansion or whatever it is that they're trying to do. Looking at these sort of base metals and industrial metals, often you're working with multi-billion dollar companies. Often there's, billion dollar plus capital costs getting these things into production. You have much better capitalized counterparties. Why would they contemplate selling a royalty? I mean, if I'm running a mine, that would be probably one of my least preferred sort of ways to raise capital. And if I had other options and I was a big company, how is it that you sort of made the value case for them that this is something they should do?
What do you mean? You wouldn't want to sell me a permanent encumbrance on a wonderful long life asset? What's wrong with me? You don't like me or something?
I mean, I would love to be on your side of that equation for sure.
Look, you're exactly right. So we started in 2011 with this. Here's our business plan. Here's what we're going to do with the money. And then we started making calls and trying to buy royalties. And the potash royalties, in fact, were held by not the operators, but an original holder. It was a company called Shearer. And we were told for quite a number of times we'd go in and we'd maybe tweak our bid a little bit, to the point that at one point I remember a phone call. It was like, these are never for sale, right? Please stop calling. Anyway, so I said, okay, talk to you in a couple of months. Anyway, the truth of it is that we couldn't get anything to transact. Those that were held independently, prices were all rocket high, and the prices we would have had to assume, metal prices going forward, we would have had to assume to make their asks were just something we couldn't do. The mining companies obviously weren't looking to raise capital by selling things. They had other easier, cheaper ways to raise capital. So we went through a really, actually pretty hard period of time, saying that we're a royalty company and we're going to buy royalties, and we couldn't buy anything. We just couldn't get our heads around paying what the ask was at the point. But don't forget, we started in a market where there was no capital available whatsoever, and watched it blossom into one where it was literally being thrown from every direction.
Yeah.
We, had enough mentors and old timers to say, yeah, you know what, that's not unique. It's this pretty much this is what happens every single time. And we waited. That was a hard thing to do for several years.
Well, I have in my notes here, your first royalty was in 2003 and your next one was in 2013. Is that correct?
Yeah, that's right. And actually it was Christmas Eve 2013, so pretty much 2014. Well, what had happened though is, so all that exuberance, say 11, 12.
Yeah.
And we couldn't buy anything because prices were sky high. Well, that was a time when mining companies were all building like crazy, right? There was just build. The narrative was that, runaway demand and high prices forever, and everyone built, leveraged themselves up to build. And of course, it all came to market, or started to look like it was coming to market at more or less the same time. So now you're into that 2012, 2013 period of time. Maybe there's been a little bit of hiccup in China and the demand narrative has fallen back a little bit. and everyone can see a wave of supply coming to the market from all this building. Well, prices had the natural impact. So copper would have went from $4s down to $2, and iron ore from 180 to $50. Well, guess what? If you just built a mine and now you're in production, you were counting on $3 copper or $100 iron ore, and you're leveraged, and now you've got bullet payments coming up on your debt. And guess what? The price doesn't barely support your operating costs, let alone make a margin that's going to cause you to, meet all these obligations to your balance sheet. And so, like by late 2015, like that Christmas period, or into early 16, the whole industry, like the good, the bad, the ugly, it was on collective credit watch. Like literally I'm sure you can find lots of newspaper articles from that, like about a 1 month period that would have included, is Rio Tinto solvent? Is Tech solvent? Who's going to Chinese bailout? Like that's where it got to. And you know what? We had a whole boatload of cash. So anyway, we bought a whole bunch of things. And that's when we didn't just use the money we'd held on to, but we borrowed as well, and we partnered with Insure. We did everything we could to put capital together and buy as much of quality assets as we could. And we could choose. We could select for those assets that were making decent margins even in this price environment. Like what a great due diligence screener. All you have to look around and say, who out there is actually making money today? Like that's probably a pretty good mine. That's one that can survive, right? Mm-hmm. And again, selecting for long life assets. So, all of a sudden, Sherritt's selling those potash royalties. And, Yamana wants to sell a copper stream on Chapada, and we could buy pieces of Labrador iron ore that, in our view, we're we're buying royalties at pennies on the dollar through their equity quote, because that's how gloomy and pessimistic the market was. And it was an incredible, wonderful time. Fairfax joined us with some of it. They came and gave us another slug of permanent type capital that we were able to deploy. And it was amazing.
So, you guys actually managed to do what basically every mining company says that they plan on doing, which is being counter-cyclical, right? Buying assets on the cheap and selling them on the high. And you were able to actually do that. And is there anything that you think has allowed Altius sort of to stand out from a lot of its competitors in executing on that? Is it just luck of timing? Is it strategic planning? Or maybe, do you think actually being based in Newfoundland has a bit of an impact on that, and being out of the fray and the deal making and the bit of the den of thieves you might find in Toronto or Vancouver? Has that had an impact on sort of being able to take a step back?
Always been a benefit, to be away from that sort of, hyper manic depressive day-to-day kind of noise that characterizes our business, and just, focusing on our knitting and thinking for ourselves probably has had a big difference. And look, if you've been in Newfoundland in the time that I've been, I'm almost 50 years here now, if you don't expect things you always hope for the best, but if you don't expect things to get ugly, your whole main industry for 500 years is suddenly shut down, and all sorts of adversities to come. If you don't expect that, and in fact almost embrace it, there's something wrong with you. So being from Newfoundland I think it made a difference in terms of our conviction that things would get better. And when I say that, it's ironic. Like 2012 and 2013, it was easy to capitulate and just pay whatever the asking price was and satisfy the market. And look, we did it. We just bought something. But by getting better, like believing this is going to get better, and by being better, getting better was really to say that it was going to get a hell of a lot worse. But that, of course, for us was going to get a lot better. And
so
Some of it too is probably not knowing enough, not knowing any better. We just, again, I mean, so now we're all the way up to our early 30s when we're making that decision, right?
Yeah.
And we didn't want to blow it up. Like we'd done a lot and we felt like we're feeling pretty proud about the business, and it just didn't feel like it made sense to make it didn't feel right in our stomachs to chase at that point. Things just felt a little too good to be true. Well, anyway, and again, we would have rather have done nothing than to blow it up. Like we would have rather said, you know what, guess what? It's 2015 or 2014 or 16, and we haven't been able to do it. Here's shareholders, here's all the cash.
Mm-hmm.
We gave it the best shot. But at least we didn't blow up value on you.
Yeah.
Thankfully, it didn't go that way. Thankfully, the business model that we decided was appropriate for what we do, that complemented our project generation business and the royalties we were creating, it was, it played out and we could do it. I'll also add here that during that period of time, we didn't just twiddle our thumbs, waiting. That same deteriorating set of conditions were wonderful for building up big land packages all over the world for our project generation business. We had lots to do. We never got bored or, sucked into making mistake because we need to do something.
Yeah.
We had lots to do.
Well, I wanted to ask you, how do you think about when deploying capital and time and resources, buying royalties versus, say, generating royalties, generating sort of land packages? Is it, you're buying royalties at the bottom of the market and then, staking and spinning out land packages at the top of the market? How do you guys sort of balance that?
We're always at all of it. Like there's special situations that pop up, but really they're both counter-cyclical businesses when they're, I think, run at their best. You should be buying royalties when, other forms of capital are expensive and hard to come by. Similarly with exploration, when things get tough, when the margin disappears at the mine, when metal prices are low, there's no capital for exploration. The mining company is the first thing to go, the exploration budget, and the capital markets shut down for those that rely on them. So that's a wonderful time to be picking up. We picked up land packages in core belts, like, there's a world-class mine. There's a world-class mine. Look, all the ground in the middle of it just became available. Like, when's that going to happen again? Take out your brain, get it all. So we were busy on that side then. What changes as the cycle goes on is that, as things get better and other capital becomes available again, the exploration budgets come back to the major companies, the juniors get funded again, and they need projects. So you get more focused on being selective about who you want to place that project with, who's going to do the best job of it, who, so, just shifts. You work with the cycle. It's the project generation side in particular is, it's very customer focused. And, you've got to go through periods of inventory building, and then because, there's the buying wave coming and you got to be ready. On the royalty side, for us now, like, we're not aggressively trying to compete with other forms of capital, whether it be from other royalty companies or just equities markets or whatever. It's just not for high quality assets. Like, it's almost inconceivable that our bid's going to get hit. That said, we're a very technical group. So if tomorrow somebody announces an interesting hold somewhere, we're on it and we're looking at it and thinking about it. And maybe before the markets really get onto it, we might see something there that makes us want to make a lower dollar size bet. But we can still make bets on royalties that are earlier stage. And of course, there's a lot more of that exploration result out there in times like this. So there's always lots to do, but never say never. But we're not very aggressive or optimistic that we're going to be, deploying big slugs of capital in the near term, buying new cash flowing royalties. And I don't think we should be.
I mean, where do you see we are us in the market right now? Do you see us sort of cresting up into a proper bull market again? Do you see us sort of trading sideways? I mean, I get sentiments of all sorts from different people here. How are you guys thinking about this as primarily investors in this space?
Halfway up. But see, I think we probably look at the starting point a little different than most do. A lot of people would say the market's turned, sometime last year.
Mm-hmm.
For us, the bottom came in 2016. And, you had that build up through 16. 17 was pretty good. 18 was good. 19 looks like a bad year, but it's only because Trump started a dumb trade war. Then, of course, we had 2020. But overall, like, things were getting more constructive and more constructive. It's really about how long has it been since the industry collectively put a lot of money into replenishing its mines. And it's 2012. So we're almost 10 years since the industry. Anyone wants to say, oh, look, prices, this is topping out. How can it be topping out? Like, we haven't done anything. We're only getting to the point here now where people are starting to talk about potentially deploying capital to build up new supply. What kills the cycle? It's, you build too much supply, you build it in a burst, it comes into the market, it crushes the price, and then over time, attrition of the mines happens, and you need to do it all over again. So until you actually see that kind of big wave of capital getting deployed and building new mines, not a lot to worry about here, because as far as I know, no mines are magically appearing and demand isn't going down overall. It's all very normal, but broadly speaking, it's obviously a heck of a lot better than it was in 2016.
Yes.
Miners are making margins. Another point there, 2016, you get to that bottom. That's all the CEOs got fired, of course, around then, because they were the ones that were there when the capital decisions were made to build all the mines, which of course the investors were screaming at the CEOs to do. That sort of gets forgotten. And now by 2016, oh, look what idiots you guys are. You all built at the same time and you blew up the market, and now you're going to get crushed. So they all get canned. And the new crop of CEOs come in who give the investors what they want to hear then. And that is, it's a whole new idea for mining. We're going to return capital to shareholders. That's what we're going to do.
Mm-hmm.
We're going to be disciplined capital allocators, and we're going to, be really focused on returns of capital to investors. So that's what they did. It was 2016. There was never a better time. Then none of these guys will ever see a time like that again to have made decisions to actually invest in their businesses. Instead, they decided to take all the capital out of the business and distribute it to shareholders.
Yeah.
When it was finally the time, right? And
few did it. The pendulum swung back.
Friedland, a few contrarians like Friedland would have done it in, with some of those projects. A few people did it. Now we're getting to the point where you're starting to hear a narrative out of the majors that, oh, we should probably start investing in our businesses again. And, a more balanced approach to capital allocation that includes, still returning capital to shareholders, but also, investing in the long-term growth of our businesses. And nothing ever changes. It's absolutely wonderful.
And I guess this is what it is, right? It's just the pendulum swinging from one extreme to another, sort of overspending to underspending. And I mean, that's why companies like yourselves have been able to be so successful in this sector.
Well, I guess the jury is out on all of that, but it feels like the right way to do it. We're doing it differently. There's no doubt. We're wedded to it now. I guess the result will be there in the end, right? So in 2016, 2017, and 15, we're doing everything we can. We're trying to find every copper that might have fallen under the couch because we want to get it to work. And now we're not that aggressive on buying up assets. The assets we've got are growing, and then because conditions are strong out there, the operators are investing in those assets now, or getting ready to. So they're going to grow. We don't really have to buy things at this point to see a really nice growth profile. Mm-hmm. We picked for assets that we're going to be invested in hot markets or better markets, and it's happening. So it's played out. But now we're actually turning up the jets a little bit on returns of capital, because we don't need it for M&A. All the growth that I'm talking about is entirely free. It's entirely funded by operators. We're beneficiaries of any of the growth without any of the capital requirements. So,
And so are you doing this through a dividend to shareholders?
yeah, well, we upped our dividend earlier this year by I think 40%. We've been busy on our buyback all year, and we've been paying down the last bits of that leverage from the buying spree. So, for us, that's what feels like the right thing to do at this part of the cycle, and for, I hope, several more years. And I think it is several more years, because what's got to come before this ends. And I'm not talking about events like 6 months or a year of nasty conditions or concern about how much utilization Chinese steel mills are going to run at versus where will it shift to Europe. Not the noise. I'm talking about the real events that have to come. Big investment decisions from mining companies. Lots of capital now getting put to ground. So what have we got to do? First thing they got to do is dust off all their feasibility studies that would have been, 4 and 5 and 6 years old by now. And the first thing they're going to find out is that there's been so much inflation in a short period of time, both geological and otherwise, that none of them are worth the paper they're written on. So they've all got to be recast. Then the board has to approve it, and then they raise the capital, and we just reset the scope of the project. That means we got to resubmit all of our permits. That's got to happen. And then you got to build it. Oh shit, look, we can't get a contractor because every single one of our peers has just put out the same call for proposals for the same engineering services, the same equipment, the same everything. And I guess the time frame we're at the point now where I could make the case that the prices are strong enough that it incentivizes operators to invest. But more broadly speaking, in our industry, the time frame from that incentivization point to when you actually get the supply response is really getting longer and longer and longer, which is why cycles are getting longer and longer.
Yeah.
People used to talk about 7-year cycles. Well, now last cycle was from bottom to bottom was 15 years.
And do you think that's permitting that's driving that primarily, that it just takes so much longer to build a mine these days?
Permitting takes longer. It's harder to do. It's everything from social licensing to, hardcore actual permitting. And it's just a lot of things. And part of it is that it's just not, more or less the same kind of deposits this time as the last time, so they're just there, and they're, everything looks more or less the same. When in the previous cycle, like in 2000, if you talked about, we've got a great copper project, porphyry project that's 0.5% copper.
Mm-hmm.
You'd have been laughed out of the room. That was geochemistry. Right now, it's a high grade deposit.
Yeah.
Well, like the undertaking, just the sheer amount of engineering and capital that goes into making something that is of that grade, the scale it has to take on to be economic, they're just not the same undertakings as they used to be. And so that complicates the permitting, and,
yeah,
it's just, it's not an easier and easier business. It's great for, like, to go back to that 2000 period, the incentive price to build a copper mine back then might have been, something a little over $1. Well, like, what would get built today at $1?
Next to nothing.
Nothing, right? So now that incentive price is $3 or $4. That's that inflation I'm talking about. That's means that the average copper deposit that you want to build has gone from, 1% down to 0.6. Well, that's geological inflation. There's other types of inflation that's alive and well here too. But anyway, the long and short of it is, I think that there are a lot of things that remain the same, but there are, there's other things that are just getting harder and harder about giving the world these metals that they so critically need, and seemingly even need even more now, and will need even more now.
Well,
real enigmas, some real neat enigmas there. Royalties, all of the benefits of the higher prices that disinflation ultimately results in
yeah,
without those cost pressures.
yeah. Well, let's kind of use that to switch gears a little bit and talk about your second royalty company, Altius Renewables.
Yep.
That from the outside seems like a big departure from your background, but I'm sure a lot of thought went into this. What was sort of drove you into this space, and why did you guys think you could be, competitive here?
Where it came from was I mentioned those potash royalties. When they came up for sale, it was actually done as a package deal. So it included royalties on these thermal coal royalties in Alberta that were
Mm-hmm.
part of these generating plants. So, sort of integrated operations. So we ended up with those. And soon after we bought them, as part of that package deal, the both provincial and federal governments came out with plans to phase out coal generation no later than 2030. One of the assets we'd acquired was meant to run to like 2055.
Mm-hmm.
So we took a big hit. Like we took a really big hit there. We had, we wrote down, we had to write off and expected like 30 years of pretty big revenues, and or 25 years. But it got us thinking about what ultimately was displacing coal in electrical generation.
Yeah.
And it was, renewables was the counter argument. That was the narrative, right? That coal could go away and renewables could come on. And, we looked at that and tried to be objective about that. I think most miners at that time, 2016, 2017, would have been almost dismissive of that idea. Oh, renewables don't work. This is silly socialist stuff. Coal's here forever, blah, blah, blah. And I had the benefit of a particular shareholder who happened to be a renewables developer in the US. He was a shareholder of Altius and he loved the royalty model. And hearing him and this stuff is, hey, Brian, this stuff is actually economic. This is not subsidy stuff anymore. The cost of generation and this stuff is really coming on. And at that point, that was the moment. It was that this isn't a socialist ideal. This isn't, environmental pressures per se that are ultimately threatening coal. Coal is going to get killed because a better, cheaper form of generation, when you looked at it holistically, when you costed out pollution and health issues and all that sort of stuff. And we, it was just that this is capitalism at its best. Coal is getting killed because there's a better, cheaper form. And we made a decision to figure out a way to take whatever coal revenue was going to come in before these mines were shut down or phased out, and to redeploy that capital. So it was a capital allocation decision into trying to figure out a way to build up a renewables royalty business. And we're pretty shocked actually to find out that it didn't exist. Like what natural resource sector? Because that's what it is. This is a sector that,
Yeah.
there's zinc and copper and nickel. These guys capture gold. These guys capture oil and gas, natural resources. These are essentially mines of wind and solar rays, right?
Mm-hmm.
And yet, look how prevalent royalty capital has been in the structures of those other sectors. In oil and gas for 100 years, and mining probably for 20 or 30. And here was this renewable space that was all about big upfront capital, low operating costs, big duration live assets. Like, in fact, resources never run out, and no royalty model operating in it. And so it never felt like much of a departure, to be quite honest with you. We'd already had royalties on electrical generation, and it was just figuring out how to do it.
Did you?
And funny, these things all tied together in a lot of ways. Like, we're excited about copper and nickel because of these trends,
Yeah.
right? Electrification trends. Well, we're reading reports about why copper is a good bet from pundits that are saying, well, because the renewables age is coming, and they're pigs on copper, and electric cars need just much more copper. There was way more intertwining than there was a sense that this is some whole new avenue. It's not like we're out buying music royalties or something.
Yeah.
We're linked.
So did you actually have to go to developers?
Biggest pressure in renewables today. So I'm talking to the kind of operators of renewable projects. Know what to talk to me about?
What, copper, lithium?
Yeah, that's about. It's like we didn't factor in all this price escalation in these projects. What are we supposed to do here? And we're intertwined.
Mm-hmm.
Sorry, I interrupted you.
No, I was going to ask, you said there wasn't an established royalty model in renewables. Did you actually was it a big education process for you with developers and sort of educating them on the model, selling them on the idea? Or were you maybe buying royalties from sort of underlying landowners that had them on solar fields or wind farms? Or how did you approach sort of developing this model within the space?
The first thing we did was recognize that we weren't very good at this stuff. Technically, we didn't have a depth of knowledge that we would have had, say, in mining. Mm-hmm. So funny enough, that shareholder I talked about, who was a developer, he had a group that were developers, and we basically partnered with them and bought their business into Altius, and they became the on-the-ground team. And very diverse set of skills in there, everything from the technical engineering side, but also just finance, structuring, legal. We had to first figure out how to do it. It's not like you could go and buy a royalty interest on a mine and register your interest against the mineral resource and title. Like there's no registry.
Right. Yeah. So how do you value it? Yeah.
And so really we had to come up with structures that would work there. Long story short, there is we basically just tied it to the footprint of the ground that would capture the energy. But anyway, that's an aside. The harder job was to just introduce the idea of royalty capital to those people that were developing and building projects.
Yeah.
Putting up a lot of cold calling, Frank and the team, and saying, hey, we'd like to talk to you about, putting a term sheet in front of you for that bill here. We want to put up some capital that's royalty for your project finance. And, it started out with, what is a royalty? And we seemed really fringe, I'm sure.
Yeah.
Eventually we got one to take it, and it really started to work for them. And another one took it. These were decent size, outfits, quite recognizable, and started to get a bit of traction. Second and third and fourth and fifth calls in some cases, or even callbacks now. We're like, tell me again about that royalty thing you were talking about. I noticed Apex just took it or whatever.
Yeah.
Those kinds of, real normal kind of business development stuff. To the point that we decided at Altius Minerals that this is happening and it has real scale potential. There's more capital being deployed in US renewables right now this year than there is in the entire mining industry globally.
Yeah.
To be a little piece of that at the royalty level here, we have to think at the right scale. And we knew that there wasn't enough resources or cash flow within Altius Minerals to fund this to its full potential. So we started a partner search, which resulted in Apollo, a big private equity shop, becoming an equal joint venture partner. So now the original company that we bought from Frank Getman and the team in New Hampshire, my old shareholder, is essentially it's a incorporated joint venture between Altius Renewable Royalties, so the Altius subsidiary, and Apollo. And the 50% that is owned by Altius or Altius Renewable Royalties is its own public company.
Yeah.
So it sounds a bit convoluted, but real simply here, Altius Minerals is the major shareholder of Altius Renewable Royalties, which is a public company, which I'm the CEO of as well. And it is a joint venture partner of Apollo in the underlying business.
Got it. And, I was looking at this today before our conversation. So Altius Renewables has about a $300 million market cap right now. I think $295 million as of today. Altius,
don't forget, that represents half of the business that's been created.
Yeah. Well, this is where I'm going with this question. So Altius Minerals has a $700 million market cap. You've been at that for 25 years. Do you think if you look 10 years into the future that your renewables arm is going to dwarf the minerals arm?
Yeah.
Just the size of the space, right? I assume, mining
I'll go further
globally.
than that. I would say the renewables royalty sector will dwarf the mining royalty sector. So I
Hmm.
don't know who the players in that will be and who'll do what, but overall, like the total amount of money deployed as royalty financing in renewables will eclipse that of mining. It's just a bigger business, and it's actually more appropriate for it.
Yeah. Well, what renewables are you focused on? Is it, this sort of classic wind, solar, or have you sort of broadened your net beyond that?
It's classic stuff. It's bread and butter, just like we do in mining. Like, these are technical calls. So ARR is not trying to be like a speculator on technologies at this point, but anything that ultimately commercializes um, and looks like a real project that can,
Mm-hmm.
support, paying us on our royalties, we're fair game. So by definition now, because that's where all the capital growth is in wind and solar. That's where our royalties are being built. Like we'd totally be a royalty holder in hydro, but guess what? There aren't any hydro
Yeah.
projects getting built. That day is probably pretty well done. Um, if well, hydrogen actually depends on other forms of renewables to work. But if other neat technologies come along, if it's tidal or whatever, and these things start to commercialize, and they probably will. Like wind turbines were not economic on their own 15 years ago. Now they're the cheapest form of generation on the grid, right? Solar is coming on real quick behind them. Where I think we'll go beyond wind and solar naturally is like we have a lot of visibility. We back 2 developers that have huge portfolios of projects. Each time they sell on a project, it has our royalty attached by virtue of us having basic grub stake them to bring their portfolios forward. And what we've noticed, even in the couple of years that we've been at this, is that originally the portfolios would have been standalone wind or solar. Particularly with respect to any new solar projects in their portfolio, all of them are now advancing as with attached storage. So
Okay.
that's 100% coming. So we're going to, by virtue of that, our royalties will attach to solar plus storage projects increasingly. It may even get to the point, probably will, in fact, that will also end up somewhere along the way backing standalone storage.
Right. And so is this sort of batteries or lithium, vanadium, or is this hydrogen? Like, how do you
Wherever the
use?
market decides it
Yeah.
wants to work, right? That's where we'll be. We're not speculating on. Altius Minerals owns, a founding interest in a lithium company. So, if it goes to, if grid scale storage goes lithium, well, great, we're covered there. But that's not what Altius Renewables is set up to do.
Mm-hmm.
So it becomes, whatever type of battery. I'm just saying that we'll be at the royalty level attached to whatever the industry ultimately adopts. And there may be multiple types of technologies that prove commercial. There may be one that ultimately emerges as the winner. Maybe it is lithium. Maybe it's something we haven't even thought about now. But like it could extend to anything that even exists today. That's like, it could be like pumped hydro if you got a circumstance. I love the idea of ultimately tying what minerals does and ARR does together somewhat. And like one idea there that's kind of real interesting to us is most mines in the world right now, if they, for example, run off of grid-based fossil fuel generation or even have like their own diesel sets, anyone who's doing that is right now thinking about converting to more renewable sites. So, I think we could be pretty unique in positioning as a capital provider to those kinds of conversions. Because if you're investing in a project, renewables energy for a mine site, if you're a traditional renewables investor, you've got a big problem on your hands because the biggest risk you've got to assess is the counterparty, which is the mine. Will it keep running long enough
Right.
to, provide our, and the miners don't necessarily want to put that investment on their balance sheets either. So I think we can really do some niche kind of stuff there, and which makes me think about old open pits becoming pumped hydro reserves and all kinds of neat ideas to play with there.
Okay.
What this industry is not is not what I thought. I thought, okay, one of the things about getting involved with renewables is we're ultimately getting into the, utilities business. And I had this idea of something that was going to be fairly staid and, almost boring kind of a space. Man, it's so dynamic. What's going on, how fast things are changing in this business right now. Shifts from everyone used to hedge out all their production in order to get their financial backing. Not dissimilar maybe to the gold hedging that used to go on to fund mines. Now all of a sudden that's not in vogue anymore, and people are wanting more market exposure because I think they actually believe that power prices, particularly from renewables, will go up. So they don't want to hedge, which is creating an opening for new forms of capital to have to come in, because now it's not going to be banks all just supporting fully hedged production. Again, that cross back and forth there, in my mind, the real opening for the gold royalty business to explode the way it did and to grow its market cap collectively the way it did was when hedging went out of fashion. When gold hedging blew up, that was the point at which the capital structure opened up and a hole got created. And you can just see it. You can see the collective market cap of the gold royalty and streaming sector just going whoosh. And it's inversely proportionate to how much hedging went on.
Yeah.
It's natural, right? If you're not fully hedged, it means you've got to have more equity or equity-like capital in your structure. You just can't lever it the way you would if a bank or debt provider thought all your risks were locked down. And parallels are pretty crazy, to be honest with you.
So are you seeing other companies come into the renewable space and attempt to deploy the royalty model? Are you witnessing that, or are you still kind of leading the charge on that one?
I still feel like we're first mover, but we're hearing things. We're hearing of groups that are trying to raise capital to, pursue. Well, I saw one and I said, geez, at least change a few words. You basically cut and pasted it from a prospectus. And others that have got twists on it. And I think other forms of capital, from private equity to bank groups, because that's what we're competing with. We're competing with other forms of capital, just like in any other business. If we start to gain adoption, they're going to quickly adapt and offer the same product and try to compete. But that's fine. I mean, it'll be disappointing if that doesn't happen. It means it's really not working. If that starts to happen, we're onto something.
Yeah. No, I always looked at the renewable space and I kind of thought it was sort of he or she who has the lowest cost of capital kind of wins, right? Because you're able to buy these projects cheaper, you're able to pay more for them, and roughly what they're going to sell for. Are you finding that to be the case? Or is there
less so?
Less so. Okay.
It was for a while because of who was at the table providing the capital. So it's infrastructure, pension type money. We're approaching projects that were being put together with offtake contracts for the power they would produce under very long duration, fixed price contracts. It's a match made for heaven for these types of investors, right? So they could come in and provide infrastructure type, and be happy with infrastructure type returns, 4% and 5%. So that everyone kind of got caught up in this is how it works. That you hedge out all your production, and then these guys will give you 4% money. And you can probably put 80 or 90% leverage on it, and off you go. And now the contracted prices you can achieve are far below the market price, and there's upward pressures on the market prices, and the hedges that were put in place, in conjunction with these contracted prices. This will probably go back down in history of renewables as a pretty monument. That Texas freeze up last year when prices shot to 9 or 10,000, and guys had to buy to satisfy contracts no matter the price, and racked up hundreds of millions of dollars worth of liabilities on projects that probably cost a few $100 million to build. And it did it in a matter of days. And these were supposed to be the risk-free hedged ones. The hedges were supposed to protect against that kind of risk, and they obviously didn't work. So now you got guys who are like, jeepers, we're taking half the market price in order to satisfy their money, what this money tells us it wants. And worse than that, the protection that the downside we're supposed to have hedged against didn't even show up. And so the last two financings we did in ARR, two investments, were groups who said, we want someone who will back us to build this project or to refinance this project under a business model that we're going with that has a significant component of the output exposed to market forces. We're not going to hedge. So that alienates that 4% money right away.
Yeah. Okay. Yeah.
Right. And it means that now it has to have more partner-like capital involved in the structure. So we don't, by investing in renewable royalties, we're not relegating ourselves to be a 4% investor. And I'll get a little dig in here, but I joked early on that I said, if we're willing to go in and do like 2 and 4% investments, we might as well be a gold royalty company. But
it's going to be a lot of sad CEOs watching this interview after that, I think.
Probably just cut that one. Okay. I apologize, but feel free to get to dig in anytime next time we see each other. And I owe you all a beer.
Noted. Well, Brian, we've been at this for just over an hour now. Is there anything I haven't asked you that you think we should be touching on today? Anything you think people should be thinking about?
Geez, we didn't even get into anything, did we?
we got into a few things. Yeah.
Well, I got to say something here that's relevant to what an investor might find interesting about the actual business as it stands today. And I think, what would I do there? I guess point to where I think the market probably underappreciates Altius the most at the moment. That's not a criticism. There's an awful lot of moving parts in Altius and things move quickly, but I touched on it earlier. They're at that part of the cycle now where there's incentivization, and the signals we're picking up from operators of the royalties that we already own about plans to grow them or to start building on new assets that we hold royalties on are really starting to mount. And I think that's where, I know how we're viewed. We're looked at, there's the net asset value of the cash flowing royalties, and there's the EV/EBITDA multiple. Well, all that goes out the window if in the next 3 to 4 years, half these mines are massively expanded and new mines get built. That optionality part of Altius today, I don't know if I've ever felt more bullish about that. Like the existing bets. So not new M&A we're going to do or this or that. Existing stuff we already own, starting to get realized and bring back to shareholders. I just feel like we're on the cusp of a whole bunch of that.
This is like the baked in upside, things you've already paid for. They're in the portfolio now.
When you bet in the down cycle, these are the things you're betting for. And so, the ultimate judge at the end of the cycle is, well, how much of those bets actually work when you go and do the retrospective on it. It wasn't hard to say we're buying a $2 copper. Guess what? We're probably going to get paid for a while at much higher prices than that. It wasn't really a massive stretch at $2 with half the copper mines in the world running at losses at that point. But if we actually select for assets that pay us, we buy them at 2 and they're paying us at 4, and at 4 or 5, the operator decides to double capacity. Now what have you got, right? You come out of all of that, you've had the better prices for the period during your payback, and you're going into the rest of the duration of the life at twice the production rate you started at. Or in the case of potash, that could go on and on for 20 cycles from now. So it feels like a lot of that's, I know it's not all going to happen. Not all the signals that we're hearing and all the bets that we've got in are going to play, but we don't need all of them to. There's a lot of big ones in there from, this champion Belcammy. Well, that'll be our biggest royalty overnight if it happened. What's Ashanti going to come, or Anglo Gold Ashanti going to come with in terms of resource on silicon? They said they've made a significant discovery. Well, how big is it? How much is our royalty worth? A gold royalty of all things in Altius, who would have thunk it? But pennies, created for pennies. Cami already made more money on the different ways around that investment than we invested in getting the royalty. And, Chapada, or how much is Lundin going to expand it by? Our investment in Lithium Royalty Corporation from a few years ago, the group there has done a lot of parallels with what ARR has done, probably a lot less visible to our shareholders, but you're going to hear a lot more about it. Those guys, have been buying up royalties on projects for several years now, quietly, and in the past quarter, 2 announced construction decisions. Like that's becoming a real business real fast, and we're almost 13% shareholder. Anyway, that's my answer, is that I feel like this is playing out the way it's supposed to, that enough of that optionality is going to come to fruition at absolutely no cost, that that we could look like a significantly different business in a couple of years.
All right. Thank you very much for taking the time today.
Thank you. It was good fun.
My pleasure.